we're in it, dudes. And I do believe we are. And I believe the declines will be very substantial.
In a recent Bridgewater Associates video, Jeremy Grantham and Ray Dalio sat down together to, in the first part, discuss the macro and what large trends they see with regard to inflation, interest rates, stocks, etc. And in the second part of the discussion, they talked about specifically what investors themselves can do right now and how to structure portfolios going forward.
And there's a supply-demand for credit that is having an effect on making us move into a stagflation kind of environment. In other words, the trade-offs between the two will become more difficult. But I think that number two influence, the political, is the most important.
So you just heard Dalio bring up stagflation, and the stagflation question has become more and more prominent recently, with people asking, is a period of high inflation combined with a decline in the gross domestic product possible in the United States? Top economist El-Erian says that it is unavoidable.
Is a recession at this point now unavoidable in the US?
It is not unavoidable, but unfortunately the probability is going up. What is unavoidable is stagflation. And we're seeing growth coming down and we're seeing inflation remaining high.
Next, Grantham brings up what he calls the impending doom indicator, referencing the S&P's superior performance over the Russell 2000. The S&P 500 typically contains larger, well-established companies, while the Russell 2000 index follows the performance of around 2,000 US small cap companies. In a Yahoo Finance article titled Comparing the Russell 2000 versus the S&P 500, they write, the Russell 2000 often outperforms the large cap S&P 500 during times of economic turbulence. So while the two stock indexes' overall performance has been similar, correlation generally high, they do diverge significantly at times.
I focus on the four great bubbles, which are characterized by nearly hysterical behavior, really seriously weird over-optimism, which is very rare, and which are characterized by accelerated price moves on the upside, and by a weird deviation on the upside between the blue chips going up and the risky stocks going down. And that is rare as hen's teeth. It happened brilliantly in 29. It happened during the year 2000, again in spades, with the S&P X growth continuing to go up through September of 2000, and the growth stocks basically going down 50%, and the internet stocks dropping maybe 60, 70% by then. So that was spectacular. And we saw a very handsome deviation between the S&P rising last year and the Russell 2, for example, dropping quite handsomely. So there was a 20, 25 point spread on the upside. And that, for me, is a pretty good indicator. The Coca-Colas may be handsomely overpriced, but in 1929 and 2000, 2001, and so on, they always go down a lot less as the bubble breaks. And that's the phenomenon that causes this very rare indicator of impending doom, which we saw last year. And so by early this year, it seemed clear to me that this was not only the real McCoy bubble, which had been clear for a year or so in terms of pricing and enthusiasm, but it had triggered this very rare indicator of impending doom. In other words, now.
Next, Grantham talks about how the crash will take place. Initially, he says it will look like 2000 and then transition into more of a 1970s style scenario, with general prices of all assets dropping as credit contracts around the globe.
We have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, is going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today.
So as usual, Grantham criticizes the Fed and also points out the insane levels of debt that the US has accumulated, saying that at a certain point, more debt does not equal more growth, contrary to popular belief.
The risks of a debt bubble breaking and the risks of an equity bubble breaking have simply not been understood by our Federal Reserve since Paul Volcker. They are incredibly naive. They haven't even got a clue. They're not even interested in the idea. The idea, Bernanke's saying, oh, the US housing market's has never declined. It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. My second point, high levels of debt are just far too often seriously dangerous and should be, in general, discouraged actively. That should be one of the responsibilities of top management, including the Fed, et cetera. And let me just give you an example. Why do you like low rates? Because it encourages debt. Why do you like more debt? Because it encourages growth. That's the argument. So let me give you the ultimate statistical test of that. We start in 1985, and we have been modestly increasing the debt to GDP ratio, all debt together, just drifting slightly up due to technology. And then the technology, I mean the introduction of more and more sophisticated financial instruments, but not rising dramatically. And then in 85, it kills to a 45-degree angle and shoots across any page and goes from about 1.1 times GDP to well over 3. So in that little window of 35 years, we triple the debt to GDP ratio. It's a big chunk of time. It's the biggest, most important economy on the planet, a pretty good test. So what happens to growth? It inflects downwards. And from 85, we grow more slowly. Grant you, there are many other factors at work. It's a complicated picture. But there is little room in that equation for the idea that more debt creates more growth. It is not proven in the data. It is held to be the case. It is an assumption like most of modern economics, but it is not proven by the data. I would suggest that there is no evidence at all that increased levels of macro debt to GDP have anything to do with growth. They have everything to do with higher risk, though, from time to time.
So as Grantham brought up, here's the US debt to GDP ratio, and moving on to what investors themselves can do to protect themselves and perhaps profit from a bubble bursting, Dalio essentially says that cash is trash, which he's been saying for a while now. Position yourself for inflation, and he references this investing box, which I will leave in the description below if you want to take a longer look at it, which shows you what you want to shift towards in a high inflationary environment. So Dalio also says to look towards emerging markets and be well diversified.
And we know that the typical well portfolio is not well balanced, with its greatest vulnerability being in that upper right quadrant in our box, which is the inflation box. And we know that we're in that environment. So from a starting point of view, I would encourage all investors to look at that box, those 4 quadrant box, that box that we have. I believe that now you can simultaneously reduce risk and raise returns, reduce risk of that portfolio by having more in that upper right quadrant, rising inflation, and you will reduce your risk.
And as for Grantham's portfolio take, he likes resource portfolios in general for inflation hedging.
So if you believe in inflation, you know that resources do very well. You also know that in the long run, it's strongly negative. It's negatively correlated, modestly, with the rest of the portfolio. As we're seeing today, when they do well, it puts a burden on the rest of the economy and they do badly. So there is a very strong case here for a resource portfolio.
And so finally, to end off, here are Dalio's comments on gold.
Gold as a overlay on a portfolio, on top of a portfolio, works like an insurance policy. Gold is a dead asset. It just sits there. But it's always it's got characteristics that are limited in supply. One of the most important things, it's the 3rd highest reserve currency held by central banks.